Hey Brian, I'm in the market to buy a home, but I hear this term a lot. Mortgage insurance, PMI. What is that? Cool. So in this video, I'm gonna be going over what PMI is, or mortgage insurance. I'm gonna break down what it is and how it works so you can make a more informed decision. For those of you that are new, my name is Bryan Sumardi and I'm your mortgage consultant. I'm here to share my experiences to help you with the home buying process. Please don't forget to like and subscribe and follow me on my other social platforms like Instagram and TikTok. And let's get back to the video. So PMI stands for Private Mortgage Insurance. It's an insurance policy so that if you default on your loan, the bank is covered. So think about when you first bought your first car, or any car actually. If you got a loan on it, you probably got gap insurance. So think of PMI similar to gap insurance. Normally most banks won't give you a lot of money unless you put a certain amount down. And similar to in this situation too. If you qualify for a conventional loan and you put less than 20% down on the sale price, we're gonna charge you PMI, or mortgage insurance. And like I said before, it's just because you're a higher risk to the bank. Or something that I'd like to say is that you have less skin in the game. For conventional loans, the PMI gets dropped automatically at 78% loan to value. So if your home appreciates all the way up to 78%, then PMI will drop off automatically. Otherwise, at 80%, you can call your servicer and ask for an appraisal to make sure that's complete and get that removed. On the other hand, if you get FHA, or if you get an FHA loan, that stays on for the life of your loan. It's a different mortgage insurance, and that stays on forever. The only way you can remove it is if you refinance to a conventional loan. PMI is typically a monthly expense that's added onto your mortgage. So generally, your mortgage is your principal and interest, how much you're paying to the loan, how much you're paying as interest, how much you're paying in homeowners insurance, how much you're paying in property taxes, possibly your PMI, and I was gonna say HOA, but HOA is not included. But it is included for your debt to income ratio, which qualifies you for your housing costs. The cost of PMI on your loan varies from the size of your loan, the type of loan you have, and your credit score. There are only two of the most common loans that don't require a PMI if you put down less than 20%, and that's for the VA loan and the USDA loan. So if you're a veteran with an honorable discharge, or if you purchase a home in a rural area approved by the USDA, you will not have to pay PMI. And here comes the age-old question, is PMI worth it, or should I just save an extra $20,000 or the $20,000 to purchase the home and not pay PMI? I don't know. I think this depends on you as the buyer. I like to break it down like this. The national average of a home in the United States is about 3.8%. And over the past 2 years during COVID, it's a lot higher than that. And when you break that down, if you just pay your mortgage on time, within 5 years, you will drop your PMI. So it really begs the question, how long do you want to stay in this home? Or you want to build equity so you can buy your next home? I have a lot of cliches about you just want to get in the game and start the game and not worry about anything else, because it's all about loving the process. I think that's a big theme in my life, I want to say. And I feel like it's with everyone's life. So during your consultation with a loan officer like myself, you can ask these questions like, how long is it going to take for me to remove my PMI? Or is it worth it to me to save 20% versus maybe paying extra couple $100s a month for 5 years and then having that drop? Because most of the time, most people make more money as they get older. So it just begs me to ask you, like, what are your plans in life? How are you gonna excel? How are you gonna get 1% better? Maybe I'm just biased, but real estate has been one of the most, easiest thing to manage for me. There was a quote I read from Richard Couch, the 80-20 principle. What gets measured gets managed. And it's easy to tell where your average home price is going to be and your monthly mortgage, because you have a bank who's controlling it for you. You know what I mean? And over time, like what other asset can you buy at a lower cost? And because land gets more scarce over time, a home appreciates while you pay down your loan. And ultimately, if you pay your home off early or pay it off in 30 years, you just have an asset, or you have a bank. How awesome is that to say, like, you have a bank? I don't know. there's so many like leverages you can use for a home in the future, like a cash out refinance, a HELOC. So whether you want to move into your next dream home or you want to start your own business, like I feel like most people don't think about leveling up anymore at a certain level. Maybe I read too much on Twitter, but it's like most people die at age 25. We just don't bury them. But maybe I'm just rambling. Anyway, thanks for watching. If you're ready for a consultation, check the links in the description, and I'll see you in the next one. Peace.